5 stocks I'm buying now, October 2024 edition. Welcome in, folks. This is my favorite video doing this channel each and every month where we get into the stocks that I'm buying in the upcoming month, being October 2024. All 5 of these stocks we go over today have major growth over the next 3 years. I'm going to explain why in this video here today. And they are all proven business models, which is something I absolutely love. So looking forward to getting this one. It's going to be a lot to go through here today, guys. So I appreciate y'all joining me. All I ask in return, put this video together for you guys on a Sunday. Spent a long time, many hours putting this video together. All I ask from you, smash that like button and make sure you're subscribed to the channel. That's all I need from you. That's it. Appreciate y'all joining me as always for this beast. Let's get in this. Stock number 1 of these 5 stocks is Cheesecake Factory. Ticker symbol on this one is cake. I mean, it doesn't get better for a ticker symbol than cake. There's nothing better than that, right? So a very low risk stock with absolutely insane reward. The stock's up about 38% over the past year, and just because it's done very well over the past year does not mean it's going to stop doing well. I think the best days are definitely in front of this company. Now you might hear Cheesecake Factory and you obviously think of the insanely successful brand, the Cheesecake Factory, right? And you might say, okay, very successful restaurant, one of the most successful restaurant chains in the history of mankind, literally, right, in the world. And you might say, what's the big deal? Like, okay, Cheesecake Factory, like, cool. Like, what is it about this company? Well, something massive with this company. And it's really 2 massive things that are game changers for this business model and for the stock price moving forward and why this stock's going to be an absolute beast. Number 1, this company has not one, but they have 2 major hit concept restaurants that they're basically going to expand rapidly over the next 10 plus years with. I can tell you this is special. The first major hit concept is Flower Child. And then they have a second major hit concept in North Italia. And so these concepts, you're going to see them expand into every major city pretty much across the entire United States of America over this next decade. And you're going to see it everywhere. And I can tell you, this is the only company I know of, and I look at all the different restaurant companies, that I am sure they have 2 major hit concepts on their hands over this next 10, 20 years. There's not one other company that I'm convinced they have 2 major success concepts over this next 10 years. And so what we're going to see play out is North Italia and Flower Child are going to move into every major city across the United States of America over this next 10 years. And that's when you have a truly special restaurant concept. It's one thing if you can be regional and you can just be in a region. It's one thing if you could just be successful in a state. If you can go nationwide across the entire United States and open up 100, 200, 300 restaurants, maybe even more than that, and be successful, and it doesn't matter if you're in Maine or you're in California, that's special. And they're the only company that I've ever found that actually has 2 legit, super successful major concepts coming down the pipe here, okay? Now, additionally, they have these other, what I call potentials. The Culinary Dropout, Blanco, and Doughbird are all potential next hits, but those aren't for sures. North Italia and Flower Child at this point in time, I'm 100% convinced those are going to be massive across the entire United States of America. Culinary Dropout, Doughbird, and Blanco are still like in that question phase. We got to test more of these restaurants in more markets, and then we can figure out maybe this is just going to be 10, 20 locations, right? Or maybe it's going to be one of those, we can call it 100 plus location opportunities. We have to see. Those are potentials though, okay? Now, when it comes to Cheesecake, the great thing with this company is I can count on this company growing revenue year after year after year after year with not only what they obviously have with the Cheesecake Factory, but then with all the expansion opportunity with North Italia and Flower Child, and then the potential concepts, right? That leaves revenue growth year after year after year coming for this company, which is very exciting. The trend is your friend. And the great thing with Cheesecake is their earnings per share is absolutely blasting higher. And I think we're still at early stages of this kind of earnings per share recovery coming out of Rona, right? Rona obviously was devastating to all restaurant concepts, right? It just was what it was. Devastated them. And then when we finally got to open back up, it was partial opens. That's a thing of the past, certainly, right? And then 2022 came, companies were kind of getting back on the right track with their earnings per share. And then 2022 came, highest inflation we've seen in many, many decades. It hurt a lot of companies heavily, including Cheesecake Factory. But that is a thing of the past. We got past Rona. We got past the highest inflation in decades. And now we're back on the right track when it comes to earnings per share. And I'm looking for earnings per share to just continue to increase even as they expand. And you're going to see more. The great news is as they expand more Flower Childs and more North Italias, the profitability is going to increase pretty rapidly for this company because those concepts can get to profitability so quickly. And as a company, as those brands get more known across different cities, across the United States, like it's going to be one of those things where from day one, right, they're already going to have the doors packed. And that's going to be extremely, extremely powerful. For right now, they're still kind of somewhat newer in a lot of these markets, right? Now, Cheesecake. The incredible opportunity here is the valuation. The valuation, 12 forward P, 11 2-year forward P. I mean, this is a company that, has insane growth over these coming years. Next year, earnings per share growth expected by analysts here is around 14%, with over 8% revenue growth expected. And when you think about the next 10, 20 years for this company, trading at a way below market multiple does not make sense at all. And that's where it's trading at. Right now, 12, you could say the market trades at like a 20 forward P roughly. So that's just crazy. Now, if I compare them, if we want to play the comparison game, because there's other options I could purchase. Texas Roadhouse, I made a lot of money on that stock in the past. Really great company. Phenomenal company. But the problem with Texas Roadhouse, they don't have a for sure next banger concept. They have a couple, they have Jaggers they're trying out, which is like maybe it's going to be, maybe it's not going to be. They have Bubba's 33, which is like maybe, we don't know. But they have their all extremely successful Texas Roadhouse brand, right? And so Texas Roadhouse is a little bit more of a question mark because they don't have those bangers coming behind them like Cheesecake does. And then we can look at something like a Chipotle. Chipotle is Chipotle, right? They're like, obviously extremely successful concept, insanely famous. And Chipotle, the one thing that Chipotle certainly lacks is certainly another brand. So when Chipotle brand is hurt, it actually can negatively affect the entire Chipotle company. And we've seen that actually recently in regards to this recent situation, right? Which I don't need to go down that rabbit hole because I don't want to make a 10-minute video about Chipotle. And then obviously we saw it with the health situation they had back in kind of like 2015, 2016 time. So Cake is going to outgrow, in my opinion, Texas Roadhouse and Chipotle from 2025 to 2035. If you're just talking about the next year, I think Chipotle outgrows Cake. But if I'm thinking about the next 10 years, I think Cheesecake's actually going to outgrow Chipotle quite significantly because Chipotle will start to reach saturation here in the next year or two in regards to locations. Some cities are already starting to get saturated. Most people in the United States are kind of living within if you look at every major city, people are living within 10 minutes of Chipotle now at this point in time. So now it's going to get tougher and tougher to really find locations for Chipotle that can be ultimately profitable in a major way, right? Cheesecake, because they have those two major concepts, they have so much expansion opportunity over this next 10 plus years. And so I look at Cake, I see a company that's going to outgrow Roadhouse, outgrow Chipotle, and I don't even think it's going to be close. And yet the valuation, forward P of 12 on Cake, 26 on Roadhouse, 47 on Chipotle, it's not right, man. It's not right at all. If we look at valuation tool here on 1000xstocks.com, the valuation model, I ran Cheesecake numbers as the following. I ran them at 9% revenue growth per year on average over from 2025 to 2028. That would put them about $5.1 billion in 2028. I ran them at a net income growth of about 12% per year during that time. I think they'll get a little leverage in that bottom line. Net income margins of 5% range. Come 2028, which is not high, but it's a restaurant industry, so generally net margins are low in this industry, right? If you're growing top line 9%, bottom line 12%, and you're a consistent company that's proven, you could probably command somewhere between about a 22, 27 PE. And so that would put the stock price at somewhere between about $103 and $127 come 2028, which would be a compounding annual growth rate on the low end about 27%, high end about 34%. So when I look at Cake here, it's a very attractive. And they've been, like I said at the beginning, it's not just about the reward potential with these stocks, incredible, gains that could be coming in these stocks. It's about, Cake's been through it. They've been through recessions, many of them, right? They've been through the highest inflation in many decades. They've been through all this stuff, horrible consumer sentiment. They've been through all of it. And at the end of the day, they make it out and they get stronger on the other side. So my opinion on Cake as far as buy levels. Now, this is for the next year. Keep in mind, Cheesecake 3 years from now, 5 years from now, or 7 years from now, or 10 years from now, I might be willing to pay a lot more for those shares than I'm willing to pay right now and over this next year. So for all these stocks I'm about to talk about, and I give you my load the boat number, my strong buy number, and all those sorts of things, just keep this in mind. Those numbers are really thinking about this company over the next year and what makes sense to buy, right? Given the risk reward profiles. So load the boat on Cake. What is that? That's under $40 a share. Any Cake that's under $40 a share, load the boat. Buy heavy, under $50 a share. Slow down on buying is kind of that 50 to 60 range in my opinion. And then as far as to stop buying, if it goes over 60. So if it goes over 60, which could happen. I mean, it could happen in the next year. Once people begin to realize the opportunity with North Italia and the opportunity with Flower Child, I think it's going to wake up a lot of folks. And I think they're really going to start to see that over the next year. Lower rate environment, which is great for expansion for Cheesecake. Keep in mind, these companies usually take out debt to build all these new locations. And so a lower interest rate environment, which we're going into, very good thing for Cake. Additionally, it's a big dividend payer. Guess what? A lot of people are about to flood over to dividend stocks because what you're going to be able to get on savings account and CD accounts is going to continue to go down and down and down. The Fed lowers interest rates, and so more and more people want to funnel into Cake. So could Cake go to 60 plus in the next year? I wouldn't be surprised. But that's kind of, if it goes over 60, it goes to 65, 70, I'll stop buying Cake, and it will just be a hold for me at that particular time. But for now, I'm kind of loading the boat, trying to buy as many shares as possible. Next one up here, stock number 2 of these 5 stocks is E.l.f. Beauty. E.l.f. Beauty. They are a growing cosmetics behemoth. Now, in regards to E.l.f., it has been on a wild ride the past year in regards to stock price. The numbers have been absolutely as stellar gets, and we'll run through those. But in terms of the stock price, it's been crazy. It's only up 8% for the year, but this stock went way over $200+ a share. And since that time, it's dropped about 50% roughly to be where it's trading at today, which is around $112. Now, E.l.f., they're at the cross sections of quality and price. And E.l.f. does such a phenomenal job of having a very high quality product when it comes to their skincare products and their cosmetics products. And additionally, the price points are very attractive. I mean, you're going to look at the bulk of E.l.f.'s products are priced $5 to $10. So this is a brand that it doesn't matter how much money you have or you don't have, you're going to be able to afford it. You're going to be able to go to your local Target, your local Walmart, buy on Amazon.com, buy directly through E.l.f. And guess what? You're going to be in a situation where you're going to be able to afford that. And that's, pretty phenomenal for this sort of industry to have that be known as quality and known as having low price. Because guess what that gives you? That gives you what is called pricing power. True pricing power. True pricing power is when you have an extremely quality product and you're probably underpricing your product, gives you even more margin opportunity over the coming years, right? Now, E.l.f. has been on a historic run. If we go back to 2019, this company was doing a little over $250 million of revenue. This, on the trailing 12-month basis, they should do $1.13 billion of revenue, which is absolutely incredible. This is a historic run. And you look at the growth rates, 9% in 2020. 26% in 2021, 30% in 2022, 79% in 2023, and on a trailing 12-month basis, 27%, a historic run for E.l.f. on a shelf. Now, when it comes to E.l.f., look at the margins. Look where the margins were back here, and look where the margins are today. That's incredible. This company's getting more and more gross margin out of their product because guess what? They have pricing power in the market. So if E.l.f. wants to go up 50 cents, $1 on different products, they can honestly do it, and their consumer base will be fine. They're going to continue to buy that product. If they move up price point 50 cents, $1, it doesn't magically make somebody say, oh, I'm not getting that now. E.l.f. would have to double the price of all their products to make people really say, oh man, E.l.f.'s gotten expensive. And you got to understand, if they even went up, let's say $1 on a product, for their margin profile, it dramatically changes their margin profile. So if they sell something at Target for $3 and Target sells that on the shelf for $5, and then E.l.f. says, we're going from $3 on that item to $4, Target moves that price then to $6 or something around there roughly. The consumer's not going to magically say, oh, it went from 5 to 6, I'm not buying my, whatever anymore. No, that's not going to happen. But what that does for E.l.f.'s margin profile is change it immensely. Now, E.l.f. hasn't really even gone after pricing that heavy yet. They could easily do that over this next 5-10 years if they want. They're mainly focused on market share because if you can grab a customer, let's say as a teen in their 20s, they are going to probably stay with you in their 30s, 40s, 50s, and so on and so forth. So E.l.f.'s really been worried about taking market share from all the other massive cosmetics brands that you could see in a Target store or in a Walmart, something like that. Look at this chart here. This shows you shareholder equity here on 1000xstocks.com of E.l.f. over time. That is beautiful. That is what I love to see when it comes to shareholder equity. Now, when it comes to E.l.f., 2-year forward P of 27 on this stock, it's way too low. For a business model as sticky as E.l.f., for a company with as much growth as this company has, for a company that continues to delight to the upside, continues to beat their numbers, this, folks, is what we call too low, way too low. Additionally, next year revenue growth, analysts only have it about 14%. I think that's too low as well. I have trouble thinking this company's going to grow anything less than a 20 number. They're expanding internationally right now. The U.S. opportunity is massive. They continue to get more and more shelf space. They continue to sell through at a faster clip than anybody out there. And so when I look at E.l.f., ooh, boy, I think there's too low on multiple fronts. Now, I ran some numbers with the valuation model here on 1000xstocks.com, and here's what I have. Okay, I ran a 22% revenue growth rate on average from 2025 to 2028, which honestly is not crazy at all. I ran net income growth of 32% on the bottom line, which is once again also not crazy in my opinion at all. Net income margins would go to about 13% come 2028, which is not crazy high, especially considering the gross margins on this company are ridiculous and they're likely going to go even higher. Now, as far as P's go, I ran it at about 38 to 48 range, which if you're growing 20% plus top line, 30% plus bottom line, guess what? You can easily command, let's call it a 38 to 48 P ratio range, which puts the stock in 2028 somewhere around 225, 284, 19% compounding annual growth rate on the low end, 26% compounding annual growth rate on the high end. Whew. And keep in mind, E.l.f. has always beaten my projections. So if I'm even running a 22% number there and a 32% number on average here, don't be surprised if they beat that. Don't be surprised at all. So what's buy pricing looking like for this stock? Oh, by the way, I thought it was just worth mentioning before we get to the buy prices. Any and every dip on E.l.f. has been a buy on this company since they went IPO many years ago. Literally every single time the stock drops big, you buy the stock and you make money. And so this stock's down about 50% roughly from the peak in that 40 to 50% range. And I think this is going to be another one of those situations that people will look back a year from now or a few years from now and be like, oh, that was another big buying opportunity. We should have been buying the stock there, right? So here's my buy prices for E.l.f. on a shelf. Load the boat is under $100. If this stock goes under 100 for any reason, it's a load the boat situation in regards to E.l.f. Buy heavy is under 125. Slow down on buying is kind of that 125 to 155 range. And then stop buying is over 160. I'm at 1,446% in this stock. I think I'll be a lot bigger number in the future. A lot bigger number in regards to this one. Stock number 3 up here of these stocks. Stock number 3 of 5 is Wynn Resorts. Wynn Resorts. So this is a truly great company. Stock price up about 8.5% over the past year. It has obviously started to skyrocket recently. And when I say recently, I literally mean in the past month and a half. Stock has absolutely taken off like a rocket ship. So what is a truly great company? I ask you that. And here's, to me, what a truly great company is. If you're a truly great company, you have top tier product and service, which is certainly Wynn Resorts. They are the creme de la creme. They are top product in the resort category, period, in the world. You have top tier management and employee force, which certainly when you really look at their employee force, they're top tier. You have top tier financials versus your peers. That would definitely be Wynn as well. And you can make it through anything. And if I think about Wynn Resorts, they made it through the great financial crisis and got out to the other side stronger than ever. They made it through the China crackdowns and they made it through stronger than ever. They made it through Rona, the worst possible situation that could ever happen for their business model. And they made it out to the other side. All these situations, the highest inflation in decades, they always make it through to the other side, and they emerge stronger coming out of that than when they went in. And that, to me, is a truly great company. That's Wynn Resorts. And guess what I want to hold? I want to hold truly great companies. This is a Wynn Resorts portfolio. They have 5 owned properties. Those would be a Wynn and Encore in Las Vegas, be the Wynn and Encore in Macau, and Wynn Palace. They're granddaddy of them all in Asia. They also have 1 property they manage, so they don't own that property anymore. They sold off the actual property, but they still operate inside the property, right? And they still, run the place, and they still make, respectable money from that. Encore, Boston Harbor, and that's that property. And then they're building this one in the Middle East right now, which is a crazy big opportunity because nothing like this really exists in the Middle East. And there's so much money. Oh, there's so much money in the Middle East, especially big money, the type of money that Wynn Resorts really attracts as very high net worth individuals. And so that property is going to be a very special opportunity over the next 10, 20 years as well. That property, by the way, is not opening anytime soon. Probably opens in, I would say, 2 years or so. Now, I know a lot of people watching this video, you've probably never been to Wynn, so you haven't experienced it. Okay, let me run you through a night at the Wynn. So last night, I was at the Wynn. I was actually sitting at this bar right here, okay? And this is at a Mexican restaurant, Casa de Playa or something like that, inside Wynn Resorts. And so at the Las Vegas property, I was right there, right, with my friend. And right here, some folks are there, kind of a hot shot in a suit right here, making sure, him and another guy making sure they have their own personal like bartender concierge type deal, and making sure the champagne bottles are the right ones, because they're kind of like entertaining these folks here, they're entertaining folks back here, right? Spending easily thousands of dollars, if not, a lot more than thousands of dollars at this particular Mexican restaurant, because they were with likely some other very high net worth individuals, and I don't know if they were trying to show them a good time or what they were trying to do, but they were definitely going to impress them. I'll just put it like that. Meanwhile, you have the highest end poker going on really in the world inside the Wynn and Encore, just slightly down, slightly away from that particular restaurant. Meanwhile, there's some 70-year-old who loves to play the high limit slots, who's playing $100 a pull right there. Meanwhile, in here, you got some guy from Shanghai who's in Vegas for the next few days, who's dropping $10,000 a hand on some high-end baccarat. Meanwhile, you got a kid that just turned 21. He's coming in from Los Angeles on his daddy's private jet. His daddy gave him $20,000 to spend for the weekend. He's going straight to Excess, the club that is pretty much the most profitable club in the entire world. And he's going to go spend with his 5 friends. They're going on their daddy's private jet. They're going to go drop $10,000 easily on bottle service at Excess. And meanwhile, the 2 doctors that are in Vegas for their 10th wedding anniversary, they just showed up in a room, and there's a bottle of champagne waiting for them, and says, welcome to Wynn Resorts, and thank you for staying with us. Enjoy your 10th anniversary. That's Wynn. So, look at this here. This goes to show you the trailing 12-month revenue in this company. Clearly, it's back. It's back. We're in full gear, moving forward now at this point in time when it comes to Wynn Resorts. Vegas properties are rolling. The Boston properties rolling. The Macau properties are rolling. Asia's back. Vegas is back. Everything's back now at this point in time, right? And of course, the U.S. economy is going to be stronger at certain times, which is going to benefit or not benefit the Wynn properties. The Chinese economy is going to be stronger, not stronger. It doesn't matter. Wynn's going to still put up their numbers regardless, right? Now, in terms of Wynn Resorts, the major profits are back. It's not just that the revenue's back. The major profits are back. The dividends are back. It's an exciting time for Wynn Resorts, right? And keep in mind, when it comes to Wynn Resorts, they're way more profitable than it seems on surface level. So after I left the Mexican restaurant, sitting outside with a friend at the waterfall show, had the best seat in the house. I loved it. And I was just looking at the property for a moment, and as admiring the property, I just had this thought of like, this property appreciates over time. If you run any rundown little hotel or something like that, your property does probably depreciate over time. Now, when it comes to depreciation and running depreciation, right, it's a non-cash expense really, but it makes your profitability, your net income, look a lot worse than it maybe really is, right? Now, running a traditional rundown hotel, you have a lot of depreciation because your useful life, if you don't really keep the property up in a nice condition and all those sorts of things, and if it's not in a great location, that hotel, you might have spent $30 million on it, but by the time it's done its useful life, 20, 30 years from now, it might be so run down that it's just a tear down, right? And the only thing of value might be the land. Wynn Resorts is different. Wynn Resorts properties, or if anything, in my opinion, have appreciated over the years. Those properties are worth more than they've ever been worth. Like if I think about those properties 10 years ago, I think they're worth even more now. Not just because the underlying land has gone up a lot, but because the building cost has gone up immensely, and they've kept those properties as top tier and as high end as you can possibly think. And so given all that, I believe those properties are more valuable today than they were 10 years ago and 15 years ago. But Wynn runs all this depreciation, so they don't have to pay a bunch of taxes, right? And meanwhile, I don't think those have depreciated. I think they've appreciated, which is absolutely pretty epic, right? And so the earnings per share, just keep in mind, if they didn't run all this depreciation, the earnings per share numbers would be dramatically higher than where they are. If I look on a trailing 12-month basis, depreciation and amortization for Wynn Resorts is around $700 million just in the past 12 months. And so keep in mind, I do not believe their properties have depreciated $700 million in the past year. If anything, I think their properties have appreciated in the past year. And so just keep in mind, whatever net income you see for Wynn Resorts, whatever earnings per share you see for Wynn Resorts, The reality is, in my personal opinion, it's actually dramatically higher, but they get massive cost savings from doing this depreciation over time. You might say, well, they have to recognize that if they ever sell the property. Sure. But are they ever going to sell these properties? Of course not. If you know Wynn Resorts, they're not going to sell the properties. Like, what the heck are you doing? They might sell the underlying piece of land. Maybe that makes sense, and just be the operator of the property. But they're not going to be interested in selling the whole enchilada. It doesn't make sense. So they're likely never going to have to pay that big tax on a gain of selling this property. So, I think there's a lot to be excited here on the more you understand it kind of about the financial statements and whatnot, right? So Wynn Resorts, here's kind of the numbers I ran. So I ran an average of 10% revenue growth on average a year over the next 4 years, so 2025 to 2028. They could do a bigger number than that. That's just what I felt comfortable with, okay, 10%. Now, net income growth, I think it'll be around 15% on average over the coming years. Net income margin's about 9% on this one, right? Because remember, their net income is very negatively affected by that ridiculous amount of depreciation they do every year. So, moral of the story is I think Wynn should command somewhere between a 20 and a 30 PE, which gives this company around a 16% CAGR on the low end and about 28% on the high end for Wynn Resorts, which is, in my opinion, very, very attractive for a company like this. The Middle East opportunity is that's one of those insane potentials there, right? Now, by the way, Wynn could potentially build property in Manhattan. They might build another property in Asia somewhere. I don't know. There's a lot of talk about potentials. I don't know. We'll see what happens there. But the only for sure that they're building is in the Middle East right now. Now, biggest important thing to keep in mind in regards to Wynn Resort stock, don't get excited or carried away with all the China-US stuff, because so much can be made of, what's going on in the US economy, bad, good, blah, blah, blah. The Chinese economy. So much can be made of China's economy is good or stimulus or no stimulus, and everybody gets carried away with this stuff, right? And at the end of the day, just understand rich people still have money. No matter what. Like, rich people still are going to be rich, okay? And so don't get carried away with all the talk about the economy and those sorts of things. Like, own a company that's going to be so strong, it doesn't matter how the economy is doing because rich people are still going to be rich, right? Now, in regards to Wynn Resorts, here's the buy prices I look at for the stock. Low of the boat is under $100 for Wynn. It's always been that. Strong buy is in that $100 to $120 range for Wynn Resorts. Slow down on the buying from about $120 to $140. And this stock is a don't buy over $140, right? And of course, that's over the next year. 3 years from now, it might be very different buy prices. 5 years from now, it might be very different. But that's, if I'm thinking about this stock over the next year, those are kind of the buy targets and what I'm thinking in regards to Wynn Resorts. So very exciting. Now, before we get into number 4 and number 5 of these stocks, if you are somebody that would like access to all my premium courses, teaching you everything I have up here, if you want access to my private community, my private Discord community, where all the members are talking all the time, keeping up to date with all these stocks, what's going on out there, me sharing my thoughts and ideas on different things. If you want access to see the $2.4 million portfolio that I buy and sell stocks in each and every week, and if you want access to 1000xstocks.com, click the pinned comment down there. You can click that, fill in an application to join my private stock group, as well as get access to 1000xstocks.com. That is access to all that stuff there. It was very exciting. Just last week, we had 7 members hit the 6-figure club. So my wife had me sign up these awards. We sent them on out. So very, very exciting. We have over 100 people that have hit 7 figures plus in their portfolios. We have, I would say, oh boy, easily over 500 people that have hit 6 figures plus in their portfolios, if not 600, 700 members that have hit $100,000 plus. So if that's a community you want to be part of, serious long-term investors, access to all my courses, access to the moves I'm making each week, access to all that stuff, and 1000xstocks.com. Once again, pin comment down there, fill an application. We'll see if we can get you access maybe in the next week or two, okay? Alrighty, guys, next one up here, number 4 or 5, is Sofi Technologies. Ticker symbol on this one, SOFI. Sofi Technologies, under an $8 stock. Stock's up 6.5% in the past year. It's been kind of a sleepy one for Sofi. So, Sofi, look at that. Is that not an awesome trailing 12-month revenue chart there? I mean, that's just a stair step. Stair after stair after stair after stair after stair after stair. It's one of those companies you can just count on. They grow revenue, they grow revenue, they grow revenue, right? Between their banking side and on their on not just their financial product side, but also on their tech side. It's incredible. Incredible company. Anthony Noto does a great job running the company. Now, Sofi has really attracted me in the past, I would say, year, because they flipped from being a major money loser to now a money maker. And so when that flip happens, usually over the coming years, there's a lot of like very exciting things that happen in the stock price. So that's why I've gotten very interested in stock, especially in 2024, as I look and I'm like, SoFi is an incredible opportunity this year for buyers out there, because we just had the flipping recently in the past year or two from that money losing, like just bad on the bottom line, to money making company, right? Which is a big moment for any stock, and especially in the finance category. Now, look at the shareholder equity and how it's increased over the past few years for the company overall. Shareholder equity, very important, especially for a bank stock specifically, right? But in regards to SoFi, you understand this company is attracting Gen Z, they're attracting millennials. I think they're going to I think they're the bank that's the most well positioned to attract Gen Alpha. And I think their tech platforms, Galileo, is going to continue to expand over this next 5-10 years in a substantial way. So the main thing I would say, this shows you the members of SoFi over time. If we go back just a few years ago, they had around 1 million members. Now they're pushing 9 million. There'll be 10 million members plus here in the very short term, which is very exciting for this company. So the bottom line with SoFi, don't get too caught up in the valuation talk, because you might be looking at this one. There's certain companies that when they just keep taking market share, which is what SoFi is doing, and they just have it over the traditional business model. You got to kind of look away when it comes to valuation, and that's what it is with SoFi. This is one of those stocks you just buy and you buy and you buy. Okay, and by the way, valuation is extremely attractive in regards to a stock, but that should not be your main kind of thought process when you're buying a stock like a SoFi here. Okay, now what are my buy prices for SoFi? Here they are. Low the boat is under $10 for the stock. Anything under $10, load the boat. Strong buy is $10 to $12 in the stock. Slow down on buying, 12 to 14, and stop buying over 14. Now, 3 years from now, 5 years from now, 7 years from now, might be very different buy prices on the stock, right? Might be willing to pay a lot more for the stock in those years, but given the risk reward right now, those are the buy prices. Watch risk levels on a stock like SoFi. You gotta watch out for that, because at the end of the day, with a stock like SoFi, you never know. You never know. Like, it's a bank. At the end of the day, it's a bank, and you never know if a bank could go bankrupt, and that would be an ugly situation. And so, I'm going to position into SoFi and continue to buy this stock, but I'm not going to go crazy with it, because it is a bank. You never know about those ones overall. Okay, so SoFi is an incredible opportunity. Stock number 5 of 5 is actually, guess what? We're going to have a whole bunch of stocks to get into. It's multiple stocks. Now, these next stocks I'm about to go through, they're not going to be my main focus in October, but there's a decent probability I could buy shares here and there, these particular stocks that we're about to go through. And so just keep in mind, those first 4 are really going to be my main focus, and these other ones might be a little bit more of an appetizer for October. Okay, first one up here, actually PayPal. I could actually buy more PayPal shares in October. And I know you might say the stock's gone up a lot, 35% gainer in the past year. Sure, it's down still massively from the top, and the valuation is still ridiculously attractive. Forward P on the stock's probably somewhere in the 15 range, which is way too low for a fintech with PayPal with this sort of growth rates and what Alex Chris is doing running this business. So PayPal, still a steal deal, even though it's up 35% in the past year. Shopify. You might say, gosh, it's up 50% in the past year. Is it really a buy? Yes, it is. Yes, it is. Absolutely. It is still a buy. This is one of those companies, kind of like I was talking about with SoFi earlier. You kind of don't really worry about valuation. You buy shares and you buy shares and you keep accumulating shares. In my opinion, it's kind of like buying Amazon 10, 20 years ago. You just got to continue to buy the stock and buy the stock and buy the stock. And you're never going to love, with a stock like Shopify, with how great their growth rates are, you're never going to love the forward P on the stock. You're never going to love the trailing 12-month P. You won't even love the 2-year forward P on the stock. The moral of the story is buy the dang stock and don't stop buying the stock, right? Estee Lauder. So this is a turnaround play. Stock's actually down significantly over the past year, down about 31%. They had the brands, multiple successful brands to make the turnaround happen. And I think the turnaround will happen. And so Estee Lauder, yeah, it's gone up a lot very recently, as in the past couple of weeks, but the stock's still down ridiculous. This should be a $300+ stock. I think the stock will get back to the $200 to $300 range over the next 3 to 5 years. And I think it's going to be a great gainer. They got a lot of work ahead, but the brands are what carry this company through. And Warren Buffett always says, own a company so great that any CEO could run it, right? And with their brands, whoever the new CEO is, they're going to have a hard time messing it up. They got a pretty incredible opportunity there. Next one is Nike. Nike's been a heavy buy for me for honestly the last several months. I'm going to start to slow down my buys in regards to Nike. My position's not quite fully built, but it's getting there in regards to Nike. And so I'm going to start to probably slow down my buying in October. But Nike is still a buy here. Next one up here, Celsius Holdings. Celsius Holdings down about 41% in the past year. This is an energy drink company, very popular energy drinks. You might drink them yourself. Very popular. Stock's been hammered. The brand's still phenomenal. The growth rates are obviously slowing down substantially for the company, and I honestly don't care. I look at Celsius, I see a company that could probably grow revenue 10 to 20% a year for a long dang time. The U.S. opportunity is still much bigger than it seems on surface level from here. The international opportunity is really substantial in regards to stock. So Celsius, extremely attractive here, low 30s. I hope it goes to 25. That would be ideal. But yeah, I got to continue to build out Celsius. That leads me to Monster Beverage. Monster Beverage is a buy here. Not the most attractive, crazy reward gain stock. Stock's down about 3% in the past year. This is more of a hedge, just in case I'm wrong on Celsius. And let's say Celsius's brand fades or something, Monster will be the biggest beneficiary of that. They are the big dog in the energy drink industry. They own Monster, they own Bang Energy, they own Rain Energy, they own some other energy brands as well, but they're the big dog in the space. So if Celsius fades, Monster has nothing to gain than that. And honestly, both could end up being winners over the next 5 years or so. Next one up here, Fubo TV, a little bit of a riskier stock, streaming TV company. It's a dollar stock, so of course it's going to be riskier. As far as legal stuff has been going very well for them here recently, and they've been bringing down their losses in a substantial way. If they continue to bring down those losses and the legal stuff continues to go their way, thumbs up for Fubo. So very exciting spec stock there, speculative stock, right, with some incredible upside potential. That's one of those that, like, would I be surprised if it 10x's in the next year or two? I wouldn't be surprised at all, right? But there's also the risk of downside of going to zero, right, when you're a dollar stock. Honest should already be out of the gulag at this point in time. When I say gulag, I'm talking under $5. It should already be above that by now. I think it's on its way there. It's just a matter of time. And when I look at Honest, everything's trending in the right directions. Revenues, margins, profitability. All trending in the right direction. Carla's doing a heck of a job running this company. The stock's up 193% in the past year, and I'm actually looking to potentially add some more shares in October. So very exciting opportunity there for a needs-based company. Alrighty, guys, hope you enjoyed today's video. If you want access to all my premium courses, access to my private community, access to exclusive videos, access to my $2.4 million portfolio and the stocks I'm buying and selling in there each week with screenshots, and access to 1000xstocks.com, click the pinned comment down there, apply to join my private stock group, and get access to 1000x. And we'll see if we can get you access in the next few weeks. Much love, and have a great day. Well, I don't know why I got a picture of Wynn Resorts at the end, but there you go.